Good morning, good afternoon, everyone. I'm Deepika. I'm the Chief Marketing Officer here at Quantel Asset Management. And with me, we have Shyam Sreenivasan. He's our CEO and founder. He's a Wall Street veteran. He's got 25 plus years of experience in the finance field. He's a Wharton MBA in finance. He's worked 23 plus years here in Morgan Stanley, and he knows the market inside out. So for us, we are in 2026. The US investors are navigating a market shaped by rapid shifts. There's interest rate uncertainty, there's AI driven market cycles, there's concentrated leadership. Most people are investing in a handful of large stocks, and there's constant headline risk around inflation. Geopolitics, policy changes, there's so many things to navigate. There's a lot of information available, but it's very difficult to differentiate the signal from the noise. So, this particular session and conversation today is about how, in this environment, we can act disciplined, structured in decision making, something that helps us to actually plan our wealth better for 2026. And here we are going to help investors to bring clarity in their portfolios, how you can use intelligent systems to organize your information and highlight risks, what are the trade-offs, supporting thoughtful decisions, and how to make better judgments and decisions around your wealth, your portfolio, your 401k, all of that. To start with, we will have a certain number of questions which Sham will lead us through. These are questions that have been sent on early on, and in addition, you're free to drop in your questions in the sidebar as well, which specifically interest you or you would like Sham to answer for you. So Sham, if that's okay, we can start with the starting of the context here. That for 2026, what structural shifts in the market make this a particularly important year for long-term wealth creation and not something for just short-term trading?
Great. Yeah, thanks, Lord Deepika. Thanks for that wonderful introduction. So, one disclaimer I would just add that I don't know everything about the market. Market even doesn't know everything about the market because it shifts so much every single day that you just need to be constantly aware of what's going on and adapt. And that's a big portion of what we are going to be talking about, how we are going to be adapting to the market, look at opportunities that always is presented by the market. Whether we grab it or not is up to us. And we are going to be talking about how we position ourselves to benefit from all that, signal that is in the market, right? So yeah, there's quite a lot of information out there. And what we as Quantel Asset Management, we are, first of all, just to introduce ourselves, we are a New York based SEC registered investment advisor. And we are currently not only having uh, under management, we also do advisory on a non discretionary basis. Along with providing a fintech platform that people who are more DIY kind of customers, they can benefit quite a lot in terms of what we have to offer. So that's just in terms of who we are. So we've been in business for more than 5 years now. We're managing mostly the mass affluent and above in terms of what their wealth is, some of the retirement account, IRAs, personal wealth, family of husband and wife. So that's the kind of like management that we do. We also have some retirement, post-retirement accounts too. That's really geared towards having a stable income. Our 90% of our wealth is in the growth focused investments. That's a quick background of who we are. So we can be seen on our website, quantel.ai. There's a lot of information in terms of our strategies, our approach, investment methodology. We use a lot of AI just in the name itself of our website is quantel.ai. So there is a lot of technology that we have that one can benefit from. On top of it, we have a team of investment professionals, registered investment professionals that can actually help in specific unique situations for our customers.
Thanks, Sham. So, moving to the structural shifts in the market, what makes 2026 different?
Yeah, 26, like every year is a different year. Every year brings up something different, right? I mean, just 1 month is gone. It feels like there is quite a bit of like market news. You take up the geopolitics, what's going on with Davos. Look at all the different situation that's happening in Japan with the yen market, all the global shifts that's happening with respect to the rare earth minerals, all the different tussle that's going on in terms of Greenland, and also, the trade wars with various different countries, some trade deals happening outside of the US, like India and Europe that just signed a deal. So much is going on, and every single news has got an impact on the market. Gold is now touched a new high. Today it just went up 4% in a single day. Silver has gone to almost more than 200% in just less than a year. So a lot of things are happening across the board, whether it's commodities like gold and silver, rare earth, or whether it's to do with growth oriented focus like AI based stocks. Now the shift is moving from the core providers of technology to the enablers of technology, like the data centers and the chip industry and all those things. So all these are opportunities that we see, and how we position this from a long-term point of view. Again, separating the signal from the noise is the most critical piece of it. And we have a unique way of approaching investments. With every one of our investments that we do, we always have a long-term view. Where is the market going directionally in the next 5 years? And then we have a short term view. How do we position ourselves in a way that will mitigate the risk when the market conditions are not very conducive, or exploit the market opportunities when the markets are conducive? So that's the way that we arrange our portfolios. We typically have a 70-30 kind of mix in terms of our long term as a short term. That's basically, you can call it dynamic hedging or dynamic asset management. And that's a very important aspect of what we do. If market suddenly tanks, you don't have to be really worried about the 70% focus, because that's a long-term view of what we have. Where is the market going directionally? Like 20 years back, it was internet. Now it's AI. There's a different phase of AI that's going in. The probably the next phase of AI is going to be how companies adapt to this new frame. Previously, it was just AI, Chat GPT, but how is Chat GPT or AI in general going to enable a lot of different businesses, one, to operationally improve their own operational efficiencies, or it's going to benefit the customers? The way that we were doing things, our own business, how we were doing 2 years back, 3 years back, is completely transformed in the last, I would say, less than a year, right? How we approach this, the capacity has improved quite a bit, even with a small team. So these kind of shifts are going to really shape up the world, the market as a whole. And it's an exciting phase. I think, who was that? Jensen Huang from NVIDIA was saying that in Davos, that we are living in an exciting times. Even Elon Musk was saying that. Obviously, they would say about their businesses and how they enable, but it is truly something that we feel. And the power is to the people who actually grab the opportunities there. So it's a once in a lifetime opportunity, and we see this as a great opportunity.
I think you bring about a great point in terms of, like, what they say, that the last best time to plant a tree was 40 years back and the next is today. And I think something that's you said just segues into the conversation ahead is that there's way too much information available on the internet, right? Like, there's tons of apps available, tons of publications, e-zines who are all, like, recommending certain stocks one over the other. So in such a scenario, like, how do you think investors can actually make confident decisions? And why, doesn't more information automatically lead to better outcomes? Like, what is it that we can do as, smart investors?
Yeah, one way of investing a lot of people do, which is a mistake, is just emotionally driven investments. Some people say something among the friend circle, they may really come across a name, and they would just go and invest quite a bit, right? It's okay to play around and get some excitement if your bets turned out to be good, but you cannot really create wealth out of it. If I have a small account in investment brokerage account, let's say a $5,000 account, I can always play around with it. If I lose $2,000 or 5,000, no big deal, right? You can always get that money back. But if you have a $500,000 of your retirement account sitting there, you cannot really invest in this kind of emotionally driven or driven out of, like, hearsays from your friends in your circle of friends. So you have to really have some informed decision making there. Either you trust investment advisors or you do the homework. Just to talk about how we approach this in a very systematic approach, we have a lot of processes built in internally. We use a lot of fundamental data, technical data, macroeconomic data, put it all together into like a model, back tested over the last 10 years period of time, see which works in the current scheme of things, right? What is the market cycle that is reflective of what might have been in the past is one way of like looking at it. And that's what machine learning is all very good at, right? You look at patterns of like various different inputs, see, what's the expectation of the market and all those things. And that's how we construct our portfolios. We start off with a huge number of assets. We shrill it down from 6,000 assets to 15 or so assets for each strategy. We have about 10 different strategies that we work with. Some strategies are focused on next gen, some focused on AI based growth, some on like value creation. Like, some stocks may not be really trading at the true value. They may not have had a great return. For example, last year, J&J didn't have a great return, but this year it's actually started turning around. So we look at ideas like that. There are like few big ideas that we work on, and we apply those ideas in terms of machine learning model and systematic model as a whole. Backtests for more than 10 years, see the patterns in terms of volatility control, whether we are able to like reduce the risk and different phases of market stress. In every 2 3 year cycle, there's always a market stress period. Last year it was during the May timeframe, April-May timeframe, when Trump announced a Liberation Day trade. So every year has got certain periods like this. How is your model behaving during those periods? Is it controlled volatility or not? And those are the way that we approach things. But this is not the only approach. There are a million different approaches by different investment managers. So what works for one manager may not work for the other. But broadly, we take our portfolio into the 70-30 mix that I mentioned about. 70% is based on the investor's risk appetite, whether it's growth oriented. A typical 40 plus year person that is our customer, we tend to encourage that person to be more long-term growth oriented person. So there's no need for that person to be too conservative because they've got at least 20 plus years in front of them. So we don't force the customer into a one way of thinking, but we generally recommend how to approach investing. Same thing would be for a 60-year-old. They could be a little bit more, they should be a little bit more conservative because the market may not turn around in some cases in a short period of time when they actually start needing the cash for their day-to-day expenses. So that advisory in terms of fiduciary is something that we offer our customers. But whichever way you offer, 70% is more about how you position your portfolio for the long term, and 30% is going to be the dynamic adjustment to the market condition. If there is a great opportunity presented, we jump in those opportunities. We jump out of it when those opportunities disappear or change from one style to the other. So those are the way that we approach, and we've got very good returns over the last 3 years. And this is some of the examples, not all of them. There's a kind of like returns that we have achieved for various different types of customers. The green is the S&P 500 benchmark, and the blue is the typical portfolio that we have for our customers, right? So not all the time will our portfolio win or succeed. There are going to be some phases in the market where the market turns down and we turn down more than the market. Those are all going to be there. But in the long run, if you've got the focus right, if you've got the consistency right, then we can actually get a differentiated return in terms of having a positive return over the benchmark. Even a strong benchmark as S&P 500, you actually have got a tendency to beat it. As you can see from the top right graph, what the lead starts growing over a period of time. at which point you say, okay, I'm a long-term winner with respect to the market, the competition with the market, right? Whatever the benchmark is. And typically we use S&P as a benchmark for moderate plus portfolios, and a Vanguard bond index for conservative portfolios.
Great. I think what you said makes complete sense, because while talking to investors and as an elementary investor myself, like until some time back, I would also just invest in index funds and mutual funds and think that I'm doing well, right? But when you really start looking at what the market and industry is going towards, you realize that you're making certain mistakes which you didn't even know that were mistakes, right? And that also, I think, is something that I'd like you to address, that where do investors most commonly go wrong? Like, do they misread the risk? Do they overreact to news? Or is it just failure to stay consistent?
So that's a good segue. That's a great question. Thank you, Deepika. So let me share just few of the mistakes that people do in general, right? Um, One of the mistake is that they are very overly conservative, right? I'll just excessive conservatism, right? So when somebody is in the 30s having 15-20% of their portfolio, a typical large investment advisor would have a mix of 20, 80, 30, 70. As the age increases, they would have lesser on equity and more on bond market and all those things, but they would still have some composition of bond or income even when somebody is much younger. So that, I would say, is more conservative. That's our view of the world, is like you don't need to be overly conservative at early stages of life, right? And but what we see in a typical portfolio, which is 401k or IRAs, there is some aspect of conservatism too early in the investment cycle. So that is problem number one that we see can be avoided. The other one is strategic positioning. I think going back to the same point is the stock returns clearly gives outsized return compared to a bond return. What bond return could give is just keep up with the inflation that's there, right? Clearly, that's not the way to invest for the long run in a significant manner, right? So that is basically going back to the excessive conservatism. The second one is about not having regular reviews of the portfolios. We have seen a lot of clients who have not looked at their portfolios in at least the last 2 years or so, right? Because these typically are 401k accounts that may be there. The market cycle changes. And yeah, while one needs to be having a long-term view, but there is always a correction that can be done if they had invested in the wrong kind of investment classes. So that's the second mistake. The third mistake is accepting performance without any benchmark comparison, right? Having a 7% return or 10% return is okay, but last year S&P had 17.7% return. So what's the greatness of having a 10% return when the market is giving 17? So that's a lost opportunity of 7%. So whether one achieves that or not is a different question, right? Not every time can anyone achieve, right? There are going to be years that even we cannot achieve. So far, so good. But if that happens, it's okay. But at least you're conscious of like where you are pegged with respect to benchmark, right? A lot of investors don't know that they need to measure benchmark. Instead of that, they would say, okay, I just need a 7% or 8% return. So that's the other mistake that we would say is if they are managing the money through an investment advisor, they have to demand for a certain performance yardstick. And that's a very important thing. Um, the mistake number four is abandoning data for emotion and opinion. We talked about it. Just following a hearsay from a friend or a colleague at work and just following that. I've seen a lot of our customers do that, investing in like penny stocks just because somebody said so, investing a lot of money, and it all just poof, right? Within no time that disappears. And those are all the things that one should avoid. Just because there is information out there, that information could just be a hearsay. Somebody tweeting something about a particular stock saying, I just heard that this stock is going to go 10x in the next 1 month. And they would dump a $10,000 on that penny stock and it would just go nowhere, right? Probably they would disappear completely. So those are the kind of mistakes that we have seen a lot of customers, particularly younger customers, do. And one should tend to avoid those kind of mistakes, and having a long-term vision of like how they want to see the portfolio perform, invest in like large cap, mid cap stocks, not micro cap stocks, etc. Those could actually do a lot of good for their long-term wealth creation. And that would be the mistake number 5. I don't know what the mistake number 4 is. Joining market opportunities too late. Yeah, this is one common mistake. Just because something has run up, today gold has run up, silver has run up. Now putting all the money into gold, now maybe gold is okay because gold has been there for thousands of years, right? But a stock that has a significant run up in like a very quick fashion, people jump into that stock at a very, very late point. They are the ones that's going to basically take all the beating, right? Because if the stock suddenly starts turning around, the reversal takes into effect, and everybody would have benefited before you, but once you get in, you're going to start taking all the heat and your portfolio will start suffering. So that kind of market cycle awareness is very important. Whether it's a industry, a sector, a stock, there is always a cycle, there is always a reversal effect, and one needs to be very conscious of like making sure they are not joining the party too late. So broadly, this is what people have to realize. Of course, information is everywhere. In Quantel, that could be a good point where we can actually quickly show what we have as a product. Let me share my screen here. So our customers have got access to quite a wealth of data, right? This is Quantel as a dashboard. You can link all your accounts that you have elsewhere. It doesn't need to be managed by Quantel. We also manage money on Interactive Broker and Charles Schwab, whichever the customer wants to choose. And we have a bunch of strategies that we can quickly talk about. You can include even your checking and saving account, credit card accounts, loans, mortgages, anything, everything that you consider as your finance can be linked to Quantel AI. Now, AI gets the data, it gets updated every single day using the OAuth-based technology. And now using AI, you can ask any and every question about each and every account. What's going on? What's my overall portfolio performance? And it also is plugged in with your phone. It sends, alerts when something goes down significantly. If there is a significant drop in your portfolio or a single stock that actually has taken a 5% or more drop, you're informed by Quantel AI at a minimum to know what's going on in your portfolio, right? You'll never be lacking information about your portfolio, but you can also ask everything about the market. What's moving my holdings in my portfolio, for example? Where am I taking more risk than I realize? So there's quite a lot of analysis that we do on all the holdings that you have. And this AI will actually be your financial advisor that's 24 by 7. You can back of your pocket. You can always ask questions about your investment. You can ask AI to construct a portfolio of what your liking is. You say, I like these stocks. Can you construct a portfolio which is very well balanced, but please add these 2 stocks to my portfolio? So we do a lot of math under the covers to optimize the portfolio, to give more diversified portfolio and all those things. Of course, the ultimate risk is taken by the customer. So this is a machine, this is an engine. It uses a lot of data. It can be wrong. It can have some errors in it, but ultimate, risk responsibility is still on the customer to make sure. But what they cannot humanly do, the machine does. Our AI does. But beyond that, they have to have a human component to validate it and before they take a decision on that. So there is this Quantel GPT that we have, which is AI. You can ask any question about the market. You can use advanced research, identify emerging themes. It does a lot of proprietary data scanning. We do a lot of number crunching every week about every single stock. You can ask, what's your outlook on a given stock? Should I buy? Should I not buy? Can you give me a detailed report on the stock? So we give almost like a 3-page report on every single stock that you're interested in. Add this as an extra input for your decision making process. It's very, very powerful tool that we have built for people who want to get a lot of information about the market, about sectors, about individual stocks, etc.
Great.
Are you able to see the screen, Deepika?
Yes, we were.
Yeah.
I think now it's stopped. Yeah.
Yeah.
Great. So Shyam, I think one of the key questions which we repetitively keep, seeing investors make like mistakes around is the 401k accounts, right? How can investors, smart investors, make their 401k accounts work for them?
So, as I mentioned before, excessive conservatism is one problem that we see in 401k, right? If at all someone can take risk, it should be the 401k. That's our view, right? Because 401k, you've got a much longer horizon before you tap into the money in the 401k account. Or when I say 401k, it's retirement in general. It could be SEP IRA, IRA, Roth IRA, anything. So one typically cannot touch that until they are 15 and a half without penalty, right? So that means that somebody is at 40 years, they still have 20 more years for it to really compound. So having an underperformance, a typical performance of 401k is 7% in a typical large 401k managed account. But whereas a typical return of S&P 500 is 10%, right? At a minimum, if we say US is an upward market moving trend over the long horizon, which is any 20-year period, market has moved up, right? Any 10-year period, market has moved up. So if you take a 10-year approach of how I would invest in, right, what happens last year, year 2022 was a negative year, minus 19% in S&P 500, right? So that's a 1 year, but 23 was a plus year, 24 is a plus year, 25 is a plus year. So, and every one of those plus years was more than 15%. Last year was 17, the year before was 23%, et cetera, right? So having a 7% average growth means that one has left a lot of opportunity on the table, right? That's a common mistake that people have. When compounding really takes effect, when people can compound their money at like say 12 to 15% compared to they compounding at 7%, now you're looking at a $10 million retirement account when somebody retires versus a $2 million retirement account when somebody retires. Now, where that makes a huge difference is when somebody is at 60, they're out of the workforce. They're not going to be getting the same job that they used to have because of the age. They cannot earn, they cannot create that magic of $8 extra million in their account, right? So all that magic was in the past. So now people have not leveraged it. People have not, and that's the biggest, learning that we try to impart in our customers is try to be more grabbing of the opportunities on your 401k. It need not be individual stocks. It could be ETFs. It could be mutual funds that's growth oriented. So that's where they have to really, on the Robinhood account that they are self-managing on a 100k account, they take a lot of risk. They say as though, okay, I'm just going to, they're very happy to make $1,000 become $2,000, but they're losing all the opportunities on 200k account becoming a 225k account, right? And that's the biggest, irony that we see in our customers is like, patting their back on a small return that they did on their own, whereas ignoring it completely on what's being managed by a retirement provider. That's a big, and all the opportunities are being given by every provider, right? The 401k administrators give those opportunities. So one has to take a very serious look at that, whether it's IRA or 401k. That's where people have to really try to beat the benchmark S&P.
Wonderful. And Sham, one of the key things, right, with it is undeniably the age of AI, where it's playing a bigger role in finance more than ever, in fact. So, how do you ensure that technology supports better judgment rather than replacing it? Like, is there a human advisor or investor? Does that still remain irreplaceable, or do you think robo advisory is the way ahead in life, in the future of investing? Like, what is your take on that?
So, Lord, 90% of the work can be done by AI, right? Because there is, as I said before, there are 6,000 plus investable, good quality stocks out there. ETFs also added to it, just adds to the complexity that one cannot really keep up with every single stock out there that's an investment opportunity, right? But so AI or any technology like that can actually, bring it down to a fewer choices one could make by collecting a lot of information. In our case, we take sentiments of the market, sentiments of the stock, fundamental data of the stock, who is saying what as an analyst, whether it's buy, strong buy. So we use a lot of data-based approach on every single stock on the 6,000 stock that we talked about, right? And then coming up with a score and normalizing the score gives you that top 10 stock. But now, does it remove the need for a human? No. There's always the final leg human component that's there. It's suggested that one always pays attention to what comes out of that list. Do you agree with it? Have that extra bit of due diligence done on those 10 stock rather than on 100 stocks. It's just not possible, right? Because before we complete analysis, the market has already moved on to the next phase of the market. So how do you keep up with that? You use the technology to help you keep up with that, but then the final mile should always be the responsible of the investor, whoever is making the decision. It could be a financial advisor, it could be an investment, the client themselves, to take care of it. But that judgment is going to be done using all the data that AI or any technology is providing, and that's what we do. There's always a human component there. We just don't let. I mean, of course, I can use Quantel GPT to say, can you construct me a portfolio, right? And still, whatever comes out of that data, I need to validate. As I said before, AI is not foolproof. It can have hallucination. It can have bad data that comes in. So if your data is actually corrupted by the data source, your AI is going to throw that information. It's not really going to be any smarter than what the data itself is saying, right? So there's always a human component that says, okay, before I actually put my real dollars to work, let me cross check and say, okay, yeah, Microsoft, I know Microsoft, I know I can validate it. But if it was some XYZ stock I have never heard of, right? I would definitely want to do a little bit more due diligence.
Got it. I think I have one closing question, and then I request anybody who, if they have any questions, you can drop them in the chat box.
By the way, Deepika, so we are open for a conversation with individuals for their specific needs. You know, there is a button that should be there in the webinar that you can probably point to. So we are giving a free consultation for our potential customers in terms of looking at their specific situation, looking at their portfolio, run their portfolio through our engine to see how it's positioned to grow in the next few years, right? We do look at portfolio analytics, the composition of the portfolio. We have the ability to do some broad kind of range prediction in terms of how it would position. Is it the right kind of risk that they're taking, or the right kind of like defense that they have? So those are the areas that we actually can help and give our opinion. Of course, it's up to the customer at the end of it to take the call based on what they think is right.
Right. So I think my last question would actually be as an investor myself, right? What is that one mindset or framework that I could carry away from today's discussion? Like, what could be your biggest recommendation to guide people like me, investors, through 2026 and beyond? Like, what is it that you would recommend?
Yeah, so the market regimes will come and go. Today it's gold, last day it was something else, next day it'll be something else, right? So chasing that all the time is just not going to be productive, right? If somebody had chased all the stock, Nvidia has already run up to so much, and if they are the last person, it may not grow beyond that. It's not a bad stock, it's still a great stock, but will it have the same kind of potential that it had 5 years back? Probably not. The answer is most probably not, right? So the opportunities are coming all the time in different areas. So one needs to be aware, but one should not at the same time chase those opportunities and be the last person to get the baton to actually start losing from there onwards. So going back to my 70-30 kind of like investment outlook, 70% be long term, 30% be more tactical in terms of where the opportunities are, would really go a long way in terms of beating that benchmark, because there's always that extra bit of boost that is required in terms of where are those opportunities coming in. Right now, we as investment managers on our accounts, we are looking at next gen stocks, helping in companies adapt to the shift. A big paradigm shift that's happening is AI, right? almost every one of us in the webinar would be able to relate to it in terms of how we operate with our own personal, day-to-day operations, as well as at our workplace, right? So all of us are actually getting impacted in a positive way with AI. How is it going to shape up? Is it a bubble? We don't think it's a bubble, right? We think there is huge opportunity there. And one would have, listened to Donald Trump, the president, in Davos, saying U.S. market is going to double from here, right? And he's basically backing on AI being U.S. being the leader in AI, right? So clearly, there's a lot of investment going on from various different countries. Saudi Arabia came to U.S. and they said they're going to pump in billions of dollars in AI. U.S. is investing as a country; they're investing billions of dollars in adapting AI. Companies themselves are investing. It's a great opportunity, but we have to be careful. Where we are investing and where are the real opportunity that's still there is an important question, because there are a lot of small stock that can actually go completely bust because of AI. There's just too many companies out there. Everyone now cannot complete a sentence without the word AI in them, right? If I were to say, of course, we have Quantel.ai, right? We have to have AI in it. But we truly have AI that people can use the power of. But a lot of AIs are not really AIs, I would say, right? So one has to be careful in terms of where they're investing, not follow hearsay, follow more established kind of data, and define a rule for your investment. That's what we help in advising as well as in managing, right? So, like I said, people are welcome to sign up for a 30-minute call with us, just a brainstorm, if at all, right? If nothing, in terms of how they can position their portfolios for the future.
Great. Open to any questions from the audience right now. There's just one question which, just drop by. It is, what is more advisable, like investing independently or investing as a family, like with your spouse or partner? Like, what is a better methodology to invest?
It's always good to have more collaborative thought process. If one person makes a mistake, the other person can rein in those, right? In terms of just consultation. So if it's a family of a husband and wife, it's always good to have both the input rather than one person taking all the call, and taking the blame also to go with it, right? So it's better not to have that all the blame on that 1% for wrong calls. But I would say investing together as a group, and a lot of friends group also together, right? I mean, in terms of like discussing ideas, discussing. So when more people come together, new ideas come in, new, informed decisions are taken with that rather than an impulsive decision are taken. So it's always a good thing to have a collaborative approach in terms of even in our own decision of investment strategies. We have an investment committee. We have a team of people that's working on various different aspects of investing, but put all that ideas together, we decide in terms of what the strategy is going to be for that next 3 months. So it's always good to have that kind of collaborative approach.
Another question is around PPLI and 401ks. Again, what is a better way to handle and have a long-term path for it? If you're already in your 50s.
So if you're already in 50 is not 50 is the I'm 50 plus, right? So 50 is the 30s now, right? You never feel old. No, but in terms of the time horizon that they have in front of them, clearly 50 is getting closer to 65, right? Is assuming 15 years is not too small. If one were to work till 65, one need not work till 65 if money is the only criteria to work, one should not be in that situation, right? If work really excites people like it does to me, right? I just love working, and particularly in the field that I am in right now, right? It's just exciting all the time. But if one has that kind of passion to work, they can work as long as they want to work, right? But if between 50 and 60 is a good time frame to compound, because once the money is there in your 401k, the compounding effect of it on a larger scale money is significant. A 10% growth on a $3 million is $300,000, right? That's probably the annual salary of an individual, even an executive working in a company. So if somebody has already accumulated $3 million in their investment account, a personal investment account or a 401k account, now that money just doing not too much of like crazy stuff, just investing in the market can get $300,000 of like good return on an average, I'm saying, right? Last year it would have been 600k. So that is the most important bit, is how do you allocate your money to be, how much to be conservative, how much to be more opportunistic, how much should be short term, how much should be long term. Those are the key decisions that could confound a user. It's always good to have the help of advisors like us to help in that regard.
Another question is around, does Quantel work as a family office, in terms of assisting with legacy planning, inheritance planning?
We do.
And
So we do the entire gamut of family office as a service for our customers. We do estate planning. We educate on the benefits of living trust, revocable trust for individuals in terms of how it benefits from the tax situation that one would encounter at a later point in time. A lot of other benefits are there in terms of like living trust. And we do have some partnerships with trust and will kind of creation tools that we give it for free for our customers. We also have got the retirement planning in terms of how much money they have right now. They could be in 40s or 50s. How do you position yourself to have the kind of money that you would need post-retirement? When do you retire? When you start retiring, how much money do you need? When can you draw the money from your Social Security? Should it be early, late? When do you convert your IRA into Roth IRA? Is it possible to convert all of it before you start actually drawing out as RMD or required minimum distribution? So all these different questions, people may not be getting the right kind of help. And we provide as a backbone, we provide the help and the tools that's required for a client to get all these answers so that they can take an informed decision.
Thanks, Shyam. I think we've overshot our time as well, and the questions we've answered. I think we will be sharing this recording with all the audience, as well as the people who had, opted in. So thank you so much for your time. Thank you so much, everyone. Have a lovely day.
Thanks a lot. Thank you very much, Deepika. Yeah, bye.